Good morning friends, welcome to The Point. In today's video, we will discuss some topics related to the national income of the country. Also, before starting the topic, you should be really clear with what GDP is. I have taken a separate video on what GDP is, but still we will have a quick revision over here because all the topics are now interrelated and are dependent upon GDP. So GDP is what? Gross domestic. So two words are very important here. First is gross, the other is domestic. So gross domestic product. Now what does this GDP means? It is the goods and services produced within the domestic territory of a country in an year. So the word important over here is the domestic territory of the country. Now what about those goods which are produced by the citizens of the country in the another country? Let's suppose if a person is a resident of India or a citizen of India, but also have a production facility in South Africa. Now, what about the production happening in the South Africa factory? So, for that, GNP is calculated whenever we include the goods produced by the citizens of a country in another country or by the companies which are registered and incorporated in India but are producing goods out of the territory of the country is included in GNP. So, whenever we have to move from, so I am providing you one trick. Now whenever we have to move from D figure to N figure, that is domestic figure to national figure, we have to add net factors income from abroad, also called as NFIA. So gross national product is referred to as total value of goods and services produced by the residents and business of a country irrespective of the location of production. Now this is very important. Why? Because in GDP the production was taking within the boundaries of the country, but in case of national product it is the production irrespective of the location of production. Why I am emphasizing on this? Because this is the game changer. D is the domestic, N is the national, and the location doesn't matter. For example, if Mr. A, who is an Indian, has a factory in South Africa, so while calculating GNP of a country, the value of production carried out in South Africa will also be included. GNP takes into account the investment made by the businesses and residents of a country living both inside and outside the country. It also takes into account the value of products that are produced by the industries of domestic origin. For an example, the way an Indian resident was moving outside and doing the production over there, it was included in the gross national product. What if if any American is coming into our country and doing the production here? So that part of the production and the income will not be included in the gross national product. That is why here it is the word net used. Otherwise, it would have been factors income from abroad. So why does this net is here? Because it is whatever the money is outgoing, we will subtract whatever is incoming. So the net figure will be added to the GDP. Again, I would reiterate the trick, that is from whenever we have to move from D to N, we have to add net factors income from abroad. Okay. Moving on to the next slide, which talks about net domestic product. Earlier we were studying about GDP. Okay. Now we have to study about NDP. Again, one trick, whenever we have to move from gross to net. Okay, gross to net. In previous slide we were moving from domestic to national. Now we have to move from gross to net. So the amount will so what do we have to reduce from it? That is the depreciation. Now depreciation, what? Every asset has its own wear and tear and has its own shelf life. So the amount by which the value of an asset is reduced every year due to its use and wear and tear, that is known as depreciation. And whenever we have to move from gross to net, again gross to net, so we have to reduce depreciation. Whenever we have to move from domestic to national, what do we have to do? NFIA. Gross to net is depreciation. That is what is explained here. Whenever we reduce depreciation from GDP, what do we get? NDP. Moving on to the next, which talks about what is net national product. In the previous slide, what we calculated? NDP. How did we do that? From GDP minus depreciation. I told you from gross to net, that is NDP. Now again from NDP that is domestic product to national product, we will add NFIA. But right now what we are doing from GNP to depreciation. Now how did we calculate GNP? From GDP we moved to GNP. So how did we do that? From domestic to national, I told you NFIA. Right, now we have arrived at this figure. Now from GNP we have to move to NNP, and I told you how to move from gross to net, that is we will reduce the depreciation, as simple as that. Again we had this figure GDP, from GDP we move to GNP, so I told you from D to N it is NFIA. Now from this gross to net we have to reduce the depreciation, as simple as that. That is what is told here and written here. Now moving on to the last topic for the day, that is the national income. So in the previous slide what did we calculated? We calculated the NNP. Now the NNP that came in the previous slide was at the market price. Now how come at the market price? So friends, the GDP we calculated, or the definition we are learning from our preliminary classes, that is gross domestic product is the final value of goods and services produced in a country in a domestic year. Yeah, so final value, what is final value? Final value always includes the taxes in it. How? I will explain. So for an example, you went to buy a mobile phone or a refrigerator, you directly pay the final price, for an example 10,000. Now what does this 10,000 includes? It also includes the GST that you have paid to the seller, right? Now from, if you want to see what was the original price of the product, fine, so how to find the original price? So you will calculate how much GST have you paid. So for example, you have paid 2,000, that was included in this 10,000. So from 10,000 you will reduce 2,000, you will come at the figure of 8,000. Now what is this 8,000? That was the original cost of the product, 8,000 plus 2,000 and the final value of the product, right? So while using this GDP, if we move to NNP the way we did using the formulas, so the NNP which comes is at the market price, obviously, because the base that we were using to arrive at NNP was the GDP at market price, so obviously NNP would also be at market price. But for but in India, national income is considered as NNP at factor cost. Not an issue. Now from NNP at market price we will move to NNP at factor cost. And how do we do that? We will reduce the taxes as we did here, also add subsidies to it if any provided by the government in the process of production, and that is how we arrive at the figure of national income. One thing you have to be really careful about is that whenever somebody asks you what is national income, it is NNP at factor cost and not at market price. Again I will repeat, it is NNP at factor cost and not at market price, and the figure from market price to factor cost, the route is you will reduce the taxes and will add subsidies. That is how we arrived at national income. So friends, I hope this topic is very much clear to you. I have given you the best way which I could provide you to learn it, so that you don't get confused ever in your exams also. So again I would say, from domestic to national you will add NFIA, from gross to net you will reduce the depreciation, and the ones from market price to factor cost, yes, I have explained you the example that you are buying a refrigerator, you are reducing the tax paid and you are getting the price, the original price of the product. So that is our national income of the country. So friends, this is all for the today's video. Thank you very much for your patience listening.